Hi, my name is Jeremy Dioso, and I would like to thank you for watching our Burkenroad Reports video presentation covering Stone Energy. The other members of our analyst team are Christian Andrews, Matthew Burston, Haoxin Chen, and Weikung Li. Today we will give a brief overview of Stone Energy as a company, discuss its stock price, our target price, and the valuation methods we used. Next we will touch on our investment thesis, followed by a discussion of Stone Energy's current plays. Lastly, we will analyze potential risks involved with investing in Stone Energy and the oil and gas industry in general. Stone Energy is an exploration and production company headquartered in Lafayette, Louisiana. It has a market cap of about $1.4 billion and an enterprise value just under $2 billion. Stone has estimated proved reserves of 100 million barrels of oil equivalent, and total reserves are 54% gas and 46% oil. Proved producing reserves are 42% gas, 58% oil. Stone Energy has $538 million of available liquidity, consisting of a borrowing base of $310 million, less $27 million in letters of credit, plus an additional $255 million of cash on hand. Stone Energy has operations in the conventional shelf, deep gas, and deep water Gulf of Mexico, the Marcellus Shale in Appalachia, and less substantial onshore plays in the Niobrara, Bakken, and Eagle Ford shales and the Paradox Basin. Here we have provided a chart from Yahoo Finance showing Stone Energy's 2-year performance as of March 29, 2012. Stone Energy's current price is $28.56, and over the last 52 weeks it has traded at a low of $14.64 and a high of $35.94. We have given Stone Energy a 1-year target price of $36, roughly a 26% increase, resulting in a rating of market outperform. To arrive at our target price of $36, we used 4 valuation methods. The first 2 were enterprise value to BOE of proved reserves and enterprise value to production. We then compared Stone Energy's proven reserves and production to that of its peer groups to arrive at the valuation. The other 2 methods are the PV10 of the 3- and 5-year net asset values. PV10 is the standard measure required by the SEC, which gives a comparable measurement of E&P company values. The 10-year PV10 is subject to great uncertainty, and thus we only chose to use the 3- and 5-year PV10 valuation methods. Our investment thesis highlights the following points. Stone Energy's reserve portfolio, consisting of roughly 50% oil and 50% gas, ensures steady growth. The recent Pompano acquisition from BP in late 2011 should have far-reaching effects for 5 or more years for Stone Energy. Some of its gas plays, including some Marcellus Shale areas and the Lighthouse Bayou, remain economic in tough markets in which gas trades recently as low as $2. Additionally, approximately 40% of Stone Energy's 2012 production is hedged, securing prices in a volatile market. Here is a map of the United States which shows Stone Energy's previously mentioned locations of operation. We will now discuss in greater detail the Gulf of Mexico and Appalachia regions. As previously mentioned, Stone Energy operates in 3 areas in the Gulf of Mexico, the first of which being the conventional shelf. Stone Energy estimates roughly 34% of its 2012 capital expenditure budget will be used in this area, primarily in development, maintenance, and plug and abandonment. As seen on the left, Stone Energy aims to maintain stable oil production in this area. The second area in the Gulf of Mexico that Stone Energy operates is deep gas. La Cantera No. 1 is now online and producing, and La Cantera No. 2 is in development and being drilled. Lighthouse Bayou, an ultra-deep well located just onshore, suspended drilling in December of 2011 for operational reasons when it reached 25,500 feet, with only roughly 1,500 feet left to drill. They expect to continue drilling in late 2012 or 2013. If the well is successful, Lighthouse Bayou's estimated potential reserves of up to 1 trillion cubic feet of gas will have a substantial benefit to Stone Energy. The last area in the Gulf of Mexico in which Stone Energy operates is deep water. Most notably, in late 2011, Stone Energy acquired the Pompano field from BP at a cost of $167 million. Stone Energy took over operations from BP on March 1, 2012, ahead of schedule. The acquisition adds roughly 17 million barrels of oil equivalent, of which 83% is oil. Stone Energy will see synergies from this purchase due to the close proximity of Pompano to its existing Amberjack and 21 leases. Moving to Appalachia, Stone Energy has roughly 75,000 acres in the Marcellus Shale. In 2012, management plans to drill 27 horizontal wells, spending roughly 30% of its estimated capital expenditure budget. With current natural gas prices low, the company will focus on its Mary and Heather areas, in which significant amounts of natural gas liquids, or NGLs, are found. These NGLs trade between 50 to 60% the price of crude oil, an obvious premium to the price of dry gas. These areas are located around the border of West Virginia and Pennsylvania. As shown on the graph to the bottom right, Stone Energy is increasing production, which highlights the economic viability of these areas with high concentration of NGLs, and this is in contrast to areas of the Marcellus Shale in which only dry gas exists and Stone Energy is halting development. Now we will briefly highlight some risks that are present when investing in Stone Energy and the oil and gas industry in general. Revenues are susceptible to market movements, and this can be seen in the first quarter of 2012, in which we saw 10-year lows for the price of natural gas. Companies also must rely on third parties to complete some operations. For example, Stone Energy relies on outside contractors to plug and abandon wells, to supply platforms, and to transport its oil and natural gas. In joint ventures in which Stone Energy is a non-managing partner, it must also rely on another company to manage the project correctly. Inclement weather may also impose significant costs to companies operating in the Gulf of Mexico, particularly between the months of June and November. In 2008, Hurricane Ike destroyed 49 platforms, accounting for roughly 1% of total production in the Gulf that year. New regulations by the Bureau of Ocean Energy Management, Regulation and Enforcement, the EPA, or other regulatory bodies may also have adverse effects on companies' bottom lines. Lastly, high depletion rates of reserves may limit a company's abilities to replace these reserves. For example, the annual decline rate of a continental shelf well is estimated to be 13% for oil and 17.5% for gas. And with that, we conclude our video presentation on Stone Energy and would like to thank you for taking the time to watch and listen. Disclaimer: the Burkenroad reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.